Hello and welcome to Weekly Property News Update. I'm Alegre-Wood and this is the 14th of January 2009. Okay, so just wanted to welcome you all back and Happy New Year. I've been in Spain for the last 3 weeks, so that's hence we haven't had any property news updates. And believe it or not, while I was over there, my laptop got stolen. So the reason we're on Wednesday and not Monday for the property news update is because I had to replace the laptop and get all sorted. But anyway, every week I'll be coming to you from Monday from now on. So what we're going to cover today. First of all, property house price predictions for 2009. What I did, I looked at a whole range of experts and what they're saying. So we'll give you a look at those. Then we're going to look at property, the new pension. Okay, the pensions are in a shambles, and property really is the only answer, even though we're seeing the drops. But we'll talk more about that. Base rate's 1.5%. I'm sure you've all heard of that. It's been on every newspaper everywhere. Obviously, good news for investors in particular, especially now that most stuff is probably going to be cash flow positive. So good news. Buy-to-let's still the answer for housings. Okay, so that's a report from ALA. Looking at overseas stuff, Spain's still the favoured overseas destination, and England invades Australia. We'll talk more about that. Okay, my thoughts for the week. Optimism returning, deals are still abound, and mortgages looking good. Alright, so let's get into it. First of all, okay, summary of house price predictions. Now what I did, I was in Spain and I thought, right, what's everyone saying? I was thinking about throwing my two bid into the prediction market, but I looked at basically everyone I could possibly find on the net and spent probably a good half a day compiling it all, okay? And this is what I come up with. On average, now we're talking 27 different people or organisations that I've quoted here. First of all, the average predicted house price drop in 2009 is 10%, okay? So houses are likely to drop on average across 27 experts, 10%. The best prediction is it'll be stagnant. Now that's from Ray Bolger from Charcoal, and he's saying it'll drop 4%, rise 4%. Okay, so that's probably the most optimistic. The worst is from our usual suspects: house price crash and capital economics. Okay, they're saying 20%. Deutsche Bank is also, but they also got hit quite hard with the subprime market. They were lending quite aggressively in 2006, 2007. Okay, recovery, they're expecting sometime between the middle of 2009 and the worst saying 2012. So over the next 3 years, we're looking at definitely recovering. All right, the average recovery period is sometime in 2010. Okay, most people are saying 2009, 2010 as being it. There's a few that go out as far as 2012. Predict the average predicted full house price recovery. So from the top October 2007 back to those prices are sometime in 2012, okay? And that's pretty much across the board, apart from the few that actually predict that we won't even see the recovery until then, all right? So if we look into predictions, okay, we've got Charcoal 0, we've got Halifax 5%. Now that was back in September, okay? They have themselves and Nationwide have decided not to offer prediction. Halifax because they're joining with Lloyd's and they don't want to compromise what Lloyd's thinks, and Nationwide because, actually I've forgotten why Nationwide it was. CML is because the sales volume is too small that they don't feel it's indicative. Okay, I'll come back next week. I'll give you next week why Nationwide did it. I can't think of it on the fly. Smart New Homes 5%, and then you can see a whole host of them at 10% here. Okay, so Centre for Economic Research and Business Research, RICS, HomeTrack, Knight Frank, Lloyd's, Rightmove, Clutton's. You've got Savills 11%. All the way down to 20%. Okay, now on some of these I've actually quoted specific people. So Savills have actually got two different predictions there, all right, from two different people. Okay, so there's a number of things. Now you can check that out on the website if you want to read it. It's just yourpropertyclub.com and look at my latest blogs and you'll see that there. It's actually good because for a long time, a lot of clients were saying, well, what's happening with the market? Well, have a look at what the experts are saying. I think we'll see that the first half of this year will be drops. And I think then we'll see the recovery happening. I just think there's too much at stake and too many people that need to start creating a pension, and effectively we'll talk more about that next, for it to continue and be drawn out. Okay. All right. So next thing, pension funds in $65 billion shambles. What they're saying is basically that pension funds have lost 17% of their value. If you take Nationwide 16.2%, or let's say 15% drop last year in property, well, funds or your pensions did exactly the same thing or a little bit worse. All right. The problem is you've got no control over that, and for that to recover, well, we'll see what happens and how long that takes. Nobody's predicting the recovery too quickly on that. All right. Okay, and that's again from our website. Okay. Bank of England cuts rates to the lowest of more than 300 years. Okay. It's a sign of the times. What they're trying to do, and this is one of the interesting things, is they're saying, traditionally politicians had monetary policy and the central banks had monetary policy, which is raising a lot of interest rates to control the economy. Well, what has actually happened now is they've lowered them to such a low level and they still not seem to be working. It's not the only tool. So they're trying all sorts of fiscal policy measures, things like tax rebates, guaranteeing loans for businesses, a whole range of measures pumping money into the economy. Okay, if you look at the US, they've already dropped to interest rates to zero, so they've got no further that they can go. So monetary policy hasn't worked yet. Now it may. There's always a lag effect, and you've got to consider that lag effect. All right, but obviously lowest rate, which is good news. Most of my portfolio, I think, is actually cash flow positive now. I haven't checked a few, but pretty much I'm going to say that I've got a cash flow positive, which wasn't the case up until now. So it can stay low for as long as I think, as long as I want. Cool. Okay, so let's go next. So buy-to-let investors could be the answer for the housing market. All right. So what Arla is saying is effectively that that buy-to-let people, if you look at the annual life expectancy of a residential property, investment averages 16.3 years, with more than 1 in 5 expecting to maintain their properties for more than 20 years. In other words, never sell, never sell, never sell. Okay? And that's the real thing. I mean, if you're looking at this as a 1 to 2 year game, buy-to-let, you're gravely mistaken. Okay? But if you're looking at over 20 years, I don't think anyone, anywhere, even capital economics or house price crash, are going to argue that you are going to make a return, and a significant return, one that can replace your pension, which is the most important thing. Okay, great. Let's look at my thoughts for the week. Bottom line, it's a new year. Optimism is returning. Already, we're seeing more and more people sign up to our website. Okay, so what people have seen is their mortgages drop, the mortgage they're paying, their buy-to-lets are cash flow positive. They're starting to get positive. They realise that the pension has to be provided for. They've got to do something for it. Okay, there's still deals abound. There's still great deals with good discounts, well below value. The prices have corrected themselves for last year's drops. So if you're getting quoted now, most of the valuers that are going in there are giving realistic prices. Okay, so whatever discounts you can get off that are going to be real discounts. Okay, now sure, you've got to put in more of a deposit. Fine, but if you've got the money, now's the time to be jumping in. Okay, mortgages looking good. Okay, cash flow is looking good, obviously with the low interest rates. Although I will say, I just took out a mortgage today, fixed rate 5.29 with Birmingham Midshires, and the variable rate that I had the choice of doing was 5.19. It's a base rate tracker plus 3.69, which is a huge margin, a ridiculous margin. What they're doing is they're profiteering. Simple as that. They're trying to restock their coffers, and I'm the one that's going to pay for it as a buy-to-let investor. But the deals are actually too good to pass on, so I'm actively buying now. Okay, and you should be investing now, if ever. Okay, so if you hear about the buying at the bottom of the market, now is the bottom of the market. We said before 10% on average across all the experts. What's they're saying? Well, as long as you're getting your price more than 10%. You're buying at the bottom of the market, and we can get there's things going for 25%, and that's real value. Okay, so now's the time to jump in if you're going to. If you've got that spare cash to put the deposit in, now's the time to jump in, because it's not going to get any lower. Even if it drops 20%, if you're getting a 25% discount, well, sure, you've got 5% of that left, but now you're at the absolute bottom, and you can make some quite a deal of money. Okay, excellent. That's it for this week. I hope you had a fantastic Christmas and New Year, and I'll look forward to coming to you every Monday morning. Fantastic. Speak to you soon.